Hey, what's up, everybody? Welcome back to Investing Sucks. So, in this video, I'm going to be talking about the one question that we've all been wondering, the one question that has baffled investors since the dawn of time, and that is what types of stocks tend to outperform the market? So, this may seem like a rather simple question, but when we actually start peeling back the layers of it, it does get much more complex. And what I'm going to do in this video is pull some very prominent academic research that's been conducted in this space over the past few decades that looked at what specific attributes companies that have historically had the best returns tend to have. Now, this is also known as factor investing, which is a term that I'm sure at least a few of you have heard before. It's something that is very central to a lot of the research being done in the investing space, where research parse through large amounts of historical data spanning many decades and spanning many geographies, trying to identify specific factors or attributes that a given stock has that have historically been proven to lead to the best returns. So what I want to do in this video is two things. One, I want to quickly go over the factors which are widely accepted in the academic research as being pervasive and persistent factors that have been proven to lead to higher expected returns. And then number two, show you how you can utilize this knowledge in your own personal investing. So first, I think it's important we define a few key terms, specifically on what it means when we're referring to outperforming the market. Because sometimes when we think of outperforming the market, we think of the term alpha. But what alpha actually is not very clear. And even if you try Googling it, you're going to get some misleading responses from even some reputable sources out there. Now, what alpha actually is excess returns generated above what a given level of risk would suggest. And to explain this further, I have a basic chart here that just shows risk and return, because we all know risk and return are related. If you want the potential for higher return, you need to be willing to accept more risk. So what alpha would be is essentially hacking this relationship through things like picking good investments, timing the market accurately, and you would achieve a return above what the given level of risk would indicate. Now, you may be wondering, how do we actually define what risk is? Because return can be pretty easily defined. We know what return is, whether we're talking about actual realized returns or expected returns if we're making projections. But what risk is a little bit more complex. And it's something that researchers and investors are still trying to figure out to this day to some degree. Although there have been some very, very convincing discoveries over the years, which we'll get into now. So in the 1960s, something called the capital asset pricing model was developed, or CAPM, which stated that a stock's expected return is a function of its risk, and risk is measured by market beta. So beta being a specific stock's returns correlations with the returns of the overall market. So stocks with a higher beta were seen as more risky, and thus they had higher expected returns. So if you wanted to construct a portfolio that did have higher expected returns, then you should be looking at adding stocks that have higher betas. Now, I myself have used the capital asset pricing model in my own personal investing, specifically when I'm doing a DCF analysis and I'm looking to determine what discount rate to use when I'm looking at the cost of equity side of that. I do use the capital asset pricing model. And how it works is the stock's beta is multiplied by the market risk premium. And the market risk premium is the difference between the risk-free rate, which is usually determined by looking at the yield on government bonds, and the expected returns of the overall market. So the difference in the added benefit you get by being exposed to the overall market as opposed to the risk-free rate, which has no risk and is just government bonds. So this would mean that a stock with higher beta, i.e. a more risky stock, would receive a higher discount rate, which makes the present value of their future cash flows that you determine as part of the DCF analysis worth less compared to a company with a smaller beta, i.e. a less risky stock. But the problem with the CAPM is it did have many observable issues where certain types of stocks were seeing persistently higher returns that were not explained simply by them having higher betas. This was being seen particularly in small cap stocks. So clearly there was more to the story. So the next major development in this space was in 1992 when researchers by the name of Eugene Fama and Kenneth French came up with a three-factor model in a research paper titled The Cross-Section of Expected Stock Returns. And the key insights from this paper were, number one, that smaller companies tend to outperform larger companies. And number two, value stocks, which they measured by looking at the price to book ratio, tend to perform better than stocks with a higher price to book ratio, which we could call growth stocks. So before this model came out, if one portfolio of stocks had better returns than another portfolio of stocks, but they had the exact same portfolio beta, then we would have deemed that as alpha because it's two portfolios with the same risk level, but one has better returns. So the reason it has better returns is due to alpha or just the skill of the portfolio manager. But what this paper also pointed out was that these higher returns were realized because these types of stocks are riskier. So it's not alpha in the sense that it's excess return above what a given level of risk would suggest, but it's greater return that investors are being compensated for because of the additional risk they're assuming when they expose themselves to these types of stocks, such as smaller stocks and stocks with a lower price to book ratio. And this risk was not at all related to beta. It was completely independent of beta. Okay, so let's get back to the question of this video. If our goal is to outperform the market, and research tells us that being exposed to these specific risks of small stocks and value stocks can help us do that, then it does seem like a smart decision, as opposed to just owning a market cap weighted index fund, which only exposes us to the risk of the overall market and not these additional risks, which have been proven by the research to lead to higher returns over time. Now, ever since this paper was published in 1992, there have been many other papers released attempting to explain a new factor and showing the research behind it. But not all of the factors are generally accepted as being legitimate, and not all factors are independent of each other, meaning one factor that we think could be leading to stocks having higher returns is really just an already existing factor being disguised as something else. So the next major development in this space was actually pretty recent. It was in 2014, where the same researchers, Eugene Fama and Kenneth French, who did the three-factor model, developed the five-factor model. So this model builds on the three-factor model by adding two additional factors, which are number one, robust operating profitability, and number two, reinvestment, which they measure as the increase in the company's book equity. And they say that companies that have more conservative reinvestment tend to perform better than companies that are investing more aggressively, which I think is a little counterintuitive, right? Because usually we think of companies that are reinvesting in themselves in a positive light. It's in a way we think we're betting on themselves. They're deferring short-term gains for better long-term gains down the road. And what this is actually telling us is the opposite is true, which I think is pretty interesting. So again, going back to the question of this video, what types of stocks outperform the market? If we think of the market as a market cap weighted index fund, which is only exposed to the risk of the overall market, then by taking on the additional risk present in companies that are smaller, that are valued more cheaply in terms of the price to book ratio, have robust operating profitability and conservative reinvestment policies, then these are the types of stocks we should be looking at. Okay, so now let's get into the good part, which is what does this mean for you and your portfolio? How can we put these insights into practice? Now, one important thing I want to clarify is that factor investing is not meant to be a stock picking strategy. It's designed to help guide your thinking about portfolio construction. So for you, that may mean adding companies with these factors to your portfolio, or it may mean adding an index fund or a series of index funds that invest in the right companies for you. And if you do want to go the index fund path, then I'd highly recommend reading this paper published by another YouTuber in this space by the name of Benjamin Felix. And it details a model portfolio that you can use to gain exposure to the factors that we just discussed. So I'll be sure to leave a link to this paper in the description of this video. But I also know that some of you are interested in using this knowledge in your own research and to your own advantage as a do-it-yourself investor, which to me, it does make a lot of sense because if you can get above average returns without having to pay any fees to an active manager or an ETF manager, then that is a huge advantage. So what I decided to do was create this script here called Fama French Factor Model Stocks, which generates a list of companies that have qualities that are similar to what the five factors have outlined. Now, if you're new to my channel, this website here is a website called Tickernomics. I'll leave a link to it in the description. It's a website that I created, and one of the key features on this website is what I'm showing here, which is scripting, which allows you to analyze large amounts of data very, very efficiently. But there are also other features, such as if we click the companies tab here, we can look up pretty much any company we want, and it gives us a bunch of data on it, like financials. We can look at trends of the company and then also charts. And then we have other features like what I showed before, which is the value of stock feature, which does a DCF analysis of a stock for you based on your assumptions, which you enter here. There's also a screener, watch list, and a bunch of features. So if you are interested in checking out this website, I'll leave a link in the description, and feel free to log on and use it however you like. But anyways, what this script here is designed to do is generate a list of stocks that have the following qualities that I'm talking about here. So these qualities are based off of the 5-factor model that we discussed. And I will say that what I've decided to use as the quantitative criteria for generating this list, I don't have a full entire research team behind me that's telling me the exact numbers to use for these. I really just did it based off of what I thought made sense. So if you do have any suggestions on how it could be tweaked or improved, then I'm open to hearing them in the comment section. But here are the 5 factors here. So number 1 is the market factor, which means the company must have a beta of at least 1, because remember, stocks that have higher betas are more risky and therefore have higher expected returns. There is the size factor, which means the company must have a market cap between 500 million and 2.5 billion. There is the value factor, so the price to book value ratio must be below 2.25. And number 4 is robust operating profitability. So for this, I said they must have a current operating margin of at least 12.5%, and the 5-year average operating margin must be at least 10%. And then for the reinvestment factor, this one was a bit more difficult to determine, but what I decided to do was say that their current book value must not be more than 7.5 times what it was 5 years ago. So again, I'm sure everyone's gonna have their own opinions on how good or bad these are. So if you want to let your thoughts known, then feel free to leave a comment in the comment section. And I'm not saying that you need to go out and buy these stocks immediately. That's not what I'm saying at all, but we can use it as a guiding factor to help us think about what types of stocks we should be looking at if we actually want to follow this strategy and follow what the research is saying. So in order to run this script, you just go to the public scripts tab here, and then you find the one called Fama French Factor Model Stocks. You click this button here, Save to My Scripts, and then it goes into the My Scripts, which you can then run it. So if we go here and select it, Fama French Factor Model Stocks, and we click Run, it'll take a few seconds, and then it'll run, and a message will pop up in the message box here, which tells us where to go to find the list. So it's saying done generating list, go to Insight Tables and select this to see the list of stocks. So Insight Tables is here. We open this and here's our list of stocks. And if I expand this, I also included the industry that the company is in. So we have the company name here, the industry, and then a few key statistics like market cap, price to book, current operating margin, 5-year average operating margin, beta, etc. And you can also export this into Excel. So that's what I did here. I exported all the results into Excel, which is the source data here. And then what I also did was I took a summary of certain data about the companies. So when I ran the script, there was a total of 139 companies that appeared in the list. And I also wanted to look at the industry breakdown to see what industries were coming up the most. And the number 1 industry was regional banks, which accounted for 23 out of 139 of the companies, or 17%. The next largest one was oil and gas, specifically exploration oil and gas companies, which was 15, so 11%. And then number 3 was asset management with 9, and then marine shipping and residential construction both had 7. And then there was a bunch of industries that only had 1 or 2, which if we look at this tab here, industry, just move this to the right a bit, and then we can see the count here. So these are all the industries that appeared in this row here. And there was a bunch that only had 1 entry, which I think the companies that only have 1 entry are the ones that are particularly of interest to me, because that shows that that one might be interesting, so it might be worth doing some more digging on. But again, like if you want to run this list, you can do so yourself on the website. And then I was also interested in looking at the dividend payers. And a lot of these companies are dividend payers. 102 out of the 139 companies do happen to be dividend payers. And this was actually an insight that Factor Investing had, where there was a research paper published, which was showing that dividend payers also tend to perform better than your average company and perform better than the market overall. And I think the reason is because if we go back to what the 5 factors are, for example, conservative reinvestment, robust operating profitability, those 2 factors would probably also mean the company pays dividends, because if they have conservative reinvestment, by nature of them paying dividends, their reinvestment is going to be conservative, because they can't reinvest back in themselves if they're also paying dividends, or they can't reinvest all the money back in themselves because some of it has to go to dividends. And they're probably only able to continue to pay dividends or into the long term and grow the amount of dividends they're paying if they have robust operating profitability. So they are able to remain profitable through the business cycle, through the ups and the downs of the recession. But anyways, guys, that pretty much does it for this video. So I hope you did find these insights valuable. If you did, then please leave a like. And if you're new to my channel, I'd appreciate it if you would consider subscribing. And I'll see you guys in the next video.